In this video, I'm going to show you why many investors are becoming concerned that the stock market is becoming increasingly overvalued today, and that there are worries that there could be a strong correction in the stock market. And first I am going to use their methodology, and then I'm going to illustrate some of the flaws in their methodology, and then bring you an approach of one of my own, and then talk about some reasons why we could be looking at least a stock market correction in the second half of 2021. I'm not going to go overboard and predict an outright collapse and crash of the stock market, because I don't think that this is going to be traditionally driven by a sudden collapse in economic growth. Instead, what I am thinking is that price inflation combined with rising interest rates will force a correction in the stock market and sort of drag that stock market price down, at least in the short run. I'm not going to say it's going to collapse the market completely, where you're just going to see this sharp drop off like we saw in the 2000s, both in 2001 and 2008, as well as if you look back in history, the 1929 stock market crash. But instead, I'm looking more like we're going to be entering a sort of several years stock market bear market per se, at least for the next couple years. Now, that being said, I could easily be wrong on this. It depends on just how much of an effect inflationary forces, particularly rising interest rates, have on the stock market. But I do think that any increase in the interest rates relative to what they are now will cause a correction within the next 6 months to a year, probably sooner than that. But anyway, we're going to get on with the video. So many investors, and this was pioneered by Warren Buffett, it's called the Buffett Indicator. They use the Buffett Indicator to value how overvalued the stock market is. So this ratio here on the left, this axis, shows you is a gauge of the overvaluation of the stock market. And what they use is that they basically use the stock market, the gross market capitalization of the stock market. So all money that is invested in stocks calculated out, and then divide that by GDP, and it tends to work fairly well. So back in the year 1996 to 97 and then to the year 2000, you can see how this ratio raised above 1, meaning that stocks were overvalued compared to the GDP, the gross domestic product of the economy of that year. And you can see that it captures the bubble, the tech bubble of 2000 very well. But there's a weakness to it, and that is that it misses the stock bubble of the 2006, 2007, 2008. And I'll go into that in just a few minutes. But look at where the Buffett Indicator is showing now. It's showing that stocks are really overvalued here. They're overvalued by a good 80%. We should be looking at about a 40% drop in stocks during the next correction or so, maybe even worse, just to get back down to a regular stock market indicator. And this is, any person who's been paying attention, this is clearly caused by the Fed. The Fed's been injecting increased amounts of money into the economy system, and it has been flowing right into the stock market. When the Fed prints money, it goes through the New York Federal Reserve. So the Federal Reserve Bank of New York is the one that actually injects the liquidity into the monetary system. And just to put things in preference here, that's why Wall Street is located in New York, because it's right by that New York Fed, and so therefore that money gets shipped right into Wall Street, and the bankers are the first people to get it, and they will bid out and create loans to businesses and such who will borrow the money, and then investors will also borrow the money and start bidding up stocks and start speculating in commodities and things. So This is definitely looking like a huge collapse that we're looking at in the stock market sooner or later. And so that's why investors are becoming increasingly worried that stocks could hit a peak, because they're wondering, well, how long can this continue? Now, what I have done is overlaid this Buffett indicator upon a 30-year Treasury rate regression. So what I've done is compared the Buffett indicator to the 30-year Treasury rate and ran a linear regression to sort of calculate where the indicator should be. So Warren Buffett pioneered the idea that you should discount your valuation of stocks to what he called the risk-free rate. The risk-free rate is the interest rate that you could receive on a 30-year government bond, because in Warren Buffett's mind, nothing was more riskless, meaning less risky, than holding a long-term 30-year government bond treasury. So the lower that treasury bond interest rates are, the higher stock market valuations can become. And this explains very clearly why investors were blind to the crash in '07 and '08. Some investors were keenly aware of the tech bubble in the 2000s, but they never saw the collapse coming in '07 and '08. But the investors are beginning to see that stocks are looking very frothy right now. And this Buffett indicator, along with the Treasury regression, tends to work pretty well with pricing in stocks. You can see how very clearly how the stocks were functioning right alongside this regression rate pretty well until the year 2000. And then when they dropped in 2008, they became underpriced compared to this Buffett indicator Treasury regression line. And so they quickly corrected. And then starting in 2018, they started to elevate and look a little bit frothy. And then, of course, with the government shutdowns in 2020, all hell just broke loose, and there was a huge breakout in stock prices despite a breakdown in economic growth. And even though the economy has rebounded, it does not justify this stock price increase. So if we were to take a look at this Buffett indicator compared to where its price should be using these investor tools, then even with ultra low 30-year treasury rates, it's showing that the Buffett indicator should be no higher than, say, 1.1 to 1.15, and yet the Buffett indicator is at 1.83. So it's pointing at roughly a 35 to 40% drop in stocks just using this tool. Now the question becomes, when is the stock market going to turn into a bear market? Well, I think what's going on right now is that investors are becoming more wary of inflation. And the reason why I say that is because when year over year inflation started hitting at about 4% in May, that's when we started noticing that the stock started to drop off. So I'm going to overlay the CPI index onto here and show you. And I want to show you when exactly investors started to become worried about price inflation and started dumping stocks, at least in the short term, before deciding to recover their positions and continue with the growth. So if we look at this here, and I'm going to try to squeeze this as close as I can to get you the latest look at this. Looks like stocks were going up, and they did have a few drop-offs and a few corrections, but stocks were going up until we saw the April numbers come out. Okay, so when the April numbers started to come out, and they came out, you have to remember now, this April CPI rate came out around May 7th, May 10th. Look at the correction here that occurred in the stock market. Okay, so there was this sharp correction, and stocks pretty much just stayed flat roughly for a month. Now they did start to increase just slightly in mid-June, but then the May consumer price inflation numbers came out, and what did stocks do? Well, they corrected downward again. Now that being said, stocks since then have resumed an upward trend, right? And there's a bullishness about the economy. The Fed has come out, and especially within the last couple of months, and tried to soothe the markets and say that these inflation numbers are temporary. They're caused by base effects. They're caused by bottlenecks. They're using every single excuse under the sun, except for admitting that their money printing numbers are what's causing this. So that in turn is leading to investors becoming bullish. But what's going to happen next Tuesday if the inflation numbers look bad? Well, we're probably going to see a stock market correction again, and I'm going to go out on a limb and say that these stock market corrections are going to get worse and worse and worse with each passing inflation number, because it starts eroding the Fed narrative that inflation is not transitory. And especially if this starts putting upward pressure on Treasury rates, particularly things to watch for is the 10-year Treasury rate, the 30-year Treasury rate, and then the 30-year fixed mortgage rate. If those interest rates start to climb relative to where they are now, then yes, we could be looking at a severe stock market correction. Now, that being said, I pointed out earlier that the Buffett Indicator had a weakness, and that weakness was that it could not capture the 2007-2008 stock bubble. And I believe the weakness is because the Buffett Indicator takes into account government spending in its GDP ratio. So what I did was strip out government spending to give you a look at the private sector economic growth, and I overlaid that against the Wilshire 5000, and you can see that the Wilshire 5000 stock index, which is the most comprehensive stock market index that's been created for U.S. stocks, grows very much in tandem and in relation to the gross private product, as I call it. It's gross domestic product minus government spending for that year. Until the year 1995. And then in 1995, we can clearly see that stocks were overvalued compared to the gross private product. When the stock market collapsed in 2001, it corrected down to around that gross private product area. Then they became overvalued again in 2007. So here we can clearly capture that in starting almost immediately in 03, 04, 05, stocks were overvalued again, and what did they do? They corrected down to about that Wilshire 5000 stock index level. That stock index level corrected down to that gross private product, and then now look at how overvalued stocks are. Stocks are heavily overvalued now. Even before the coronavirus, they are so grossly overvalued that according to this very conservative measure, stocks could be overvalued, say 4 to 1, 5 to 1 if we use the actual aggregate U.S. market value capitalization, which is the official way to calculate the Buffett Indicator. I just use the Wilshire 5000 as a sort of quick and dirty way to say, yeah, stocks are really, really overvalued. But regardless of whether you use the standard Buffett Indicator or if you use my model, stocks are really, really high priced. And I'm not going to go out and predict that stocks are going to correct down to this level, okay? I am not saying that stocks, we are going to see a 75 to 80% collapse in the stock market, because these two collapses were driven by credit bubble burst brought on by rising default rates. Now, I do think that that's possible in the near future, in the next couple of years, if rising interest rates increase debt costs to a level that we do see a rise in default rates and delinquencies on loans. But that's something I'm going to cover in a later vid. Instead, what I want to point out is that what we could be seeing is a correction in the stock market driven by rising interest rates because of a fear from rising inflation. So rising interest rates deteriorate the overvaluation of the stock market compared to those interest rates. But regardless of whether you use the Buffett Indicator or if you use my model's overvaluation tool and compare that to the 30-year Treasury rate, it doesn't really matter. Stocks are just so overvalued now, they've got to come down sooner or later. So I think that we're going to be seeing a bear market probably in the next few months. And it won't be just a collapse in the stock market like I said before. Instead, what we're going to see is stocks drag down and then kind of bounce back up and then drag down again in the coming months. But it's just going to be a long-term bear market. And I don't think that they'll ever correct down to this ratio level, so to say, right? Even at this 30-year Treasury rate level, even though the stock market is so overvalued, the 30-year Treasury is saying that stocks at best should be overvalued, maybe 1.8 to 2 to 1 using my methodology, and yet stocks are clearly way higher than that. They're 3.5 to 4 times so. Definitely pointing to at least a 50% correction in the long term, but I do think that inevitably there will become another credit bubble burst brought on from all this money printing and cheap debt, and when those debt costs rise, and we're going to see a severe crash in the long run. So yeah, I think that in this case, if you've been looking at on YouTube, there's been a lot of worries about the stock market crash. So if you just YouTube stock market crash 2021, you can see that CNBC's worried about it. Steve Forbes has come out and started making predictions of a crash, and he's talking about how this is going to be coming from inflation. As a matter of fact, there's a lot of YouTubers out there talking about this, and actually in this realm, I think that they're sensing a problem, and even investors are getting jittery. So it's something to look out for, and it's something to be cautious in your investments. It does not mean that all stocks will just plummet. Instead, it will mean that probably the most overvalued stocks will have a severe correction, particularly in tech industries. But some stocks may actually benefit from all this, such as oil, because oil prices have been rising in certain commodity stocks. So keep an eye out for that, and just pay attention to it. And once again, this is another opportunity and another reason to sort of save your money and try to preserve your wealth in hard assets like gold and silver. Thanks for watching this vid. If you like the video, click a like and subscribe to my channel for more content. Again, guys, I'll be updating pretty regularly because the economic data that's been coming out in the news is just coming out one after another, and it's not looking like the economy is going to stay stable for long. But I'll give you my in-depth analysis and call it like I see it. And if the worst should come and the doom and gloom is actually going to become a reality, I'll try to put it on this channel and give you guys fair warning for it. So thanks for watching, and stay tuned for future vids from me.